Morning everybody, welcome to the weekend general update, and the big question of course, what is the huge rebound that we saw in America on Thursday night and Friday night? What does that mean for the correction? Is it finished or is it still under progress? So not sure I know the answer to that question, but let's have a look at the backdrop to what's going on around the world, and let's have a look at the charts and see what we can determine in terms of probabilities. So let's have a look first of all at something that I do at the start of each month, and that's our trading results on the recommendations that go out through our daily alert service. And for those of you that have been following these videos for a little time now, we'll note that the profit has slipped back just a little bit. We haven't made any progress in the last couple of months, and that's really consistent with the way the Australian market has been. The reality of 2013 was that we made most of our money in the periods 4 to 6 weeks after the corrections. And other than that, the Australian market really has been pretty hard work. Outside of half a dozen stocks, the banks and a few other major stocks that have gone up. But the general market itself has really struggled a bit, and buying after corrections into the right sort of stocks has been a profitable exercise. And look, we're still nicely in front. That profit is based on a trading float of $20,000. And we're risking $300 risk per trade. So it's a standard risk per trade setup. The trades that we've taken since the start of 2013, there's been 69 of them, and 64% of them have been successful. That has slipped back a little bit. We don't have a lot of open trades at the moment, and this does include open trade positions. And our average winner has been nearly 1.5 times the size of our losses. So for most traders, those numbers are pretty good. But I expect that once this correction that we're in completes and we get back into another period of buying, that those profit results will jump up quite well, because a couple of the positions that we're in have lost ground. We've been in them now for quite some time. They've lost ground just in the last few weeks, which has dragged that overall result back, but they're now oversold, very attractive, so I'd expect them to bounce back pretty quickly. Now, moving on to why I remain so bullish on stock markets for certainly 2014 and possibly into 2015. And I could spend a week talking about this, but I just want to cover it in a few minutes, so I'll be very brief. China, imports and exports are still surging. The people that want to be bearish on China are still pointing to the things that they can find that are wrong with China, and therefore assuming that it's going to collapse. But the proof of the pudding is in how much is being imported into the country. So that's a level of their economic activity, and also how much they're exporting, which is still their competitiveness, and both are still going along pretty well. And the imports of iron ore and coal and even gold are accelerating. They're not just progressing at a steady rate. The rate of increase is actually accelerating. So those that want to pull apart China, I think, are on the wrong track. America, similarly, there's been a long stream of economic improvements. It's not fantastic, but it's heading in the right direction with respect to housing, with respect to jobs, GDP, economic growth, corporate profits. Wherever you look, there are certainly good signs in America that things are on the improve. You look at Japan, the financial experiment there, which is needs to work. And it does seem to be working. It's a high-risk approach that the Japanese government is taking, but it certainly does seem to be working at the moment. And then finally to Europe, again, there's a lot of people lining up to tell you how crooked Europe is, but Europe's better than most people think. And again, you've just got to look at what is, not what you think should be. And the reality over the last 6 months or so, in particular, it's been going on for a couple of years, but over the last 6 months, there's been a massive amount of bond buying in Spain, Italy, Portugal, huge amounts of capital inflows into those countries. Now, the funds that are putting that money in, they're some of the smartest people in the world. They're not doing that to take an undue risk. So you can only conclude that they are seeing that the economies are on the mend. And I've just read that Spain has just come up with the first positive economic GDP number in about 3 or 4 years. So things definitely on the mend, and stock markets have been on the rise there for certainly a good part of 2013. So things in Europe better than most people think, and that's why I'm bullish. Now here's the Spanish bond yields. So at the height of the crisis in 2011 and 12, you can see bond yields spiked up above 7%, got closer to 8%. They're now down to about 3.7. That is a massive, massive drop. And those 10-year Spanish bond yields are on par with Australian government bond yields, which doesn't make a lot of sense to me, but anyway, that's what it is. So when there's fear around, then bond yields spike up high. When people are comfortable that the economics are going along well, then the value of bonds or the yield on the bonds is falling. So turning now to the specifics, the S&P index gained 15 points on the week. It was a pretty wild ride. We saw a dip to the 150-day moving average. But from here, is the correction finished? I'm not convinced. And we'll see that when we look at the chart. There's some unusual price action, to say the least. Now, high quality stocks have led the charge higher in the US and indeed around the world since 2009. But now some of the worst performing sectors of the last year or two, in particular mining stocks and gold stocks, are definitely on the move. So there is definitely a rotation of money out of the higher dividend paying stocks and into more of the growth part of the cycle. Let's take a look at the S&P index. So we'll just do a quick recap. Now you can see that there are two cases that I believe would apply. If we're going to have a very, very mild correction, then 1773 was a target level, and that also corresponded to these little highs in October and also this low point in December. So that 1770 area was a key zone of support and resistance. Now you'll notice that on Monday, the market sliced through there very, very powerfully. And generally such a definitive break of a support level means that the market is going down for a period of several weeks generally. Now, that turns then to what levels? So 1725 was a likely level. That's the 61.8% retracement of this recent run from the low in October. It also corresponded to this reasonably significant high in September of last year as well. So that was a target. It also had us around about the 150-day to 200-day moving averages, which are also important as well. And the reason that they become important and they do dictate where prices are going is because there's millions of traders around the world that are watching those levels, and they do tend to either buy and sell depending on the price action around that level. And so to a degree, they become self-fulfilling levels. So 1725 was a level. The other possible level, if we took a bigger picture view from the last significant low in 2012, was that we may have had a retracement back to the first Fibonacci level of that range, which brought us in at around about 1660. Now that also corresponded to these peaks in May of 2013 and roughly to the lows in October as well. So that all lined up very nicely. So I was looking for 1725 as a minimum and 1660 as probably the maximum decline. Now, what has transpired is that following that big fall on Monday, we had a bit of stability Tuesday and Wednesday. The market rallied back on Thursday, so that's a retest of the breakdown, which is quite normal. So looking for an ABC pattern to the downside, then this would have been our A leg. Looking for a B leg to the upside as a retest, and then the C leg to the downside to wherever that was going to go, whether it be 1725 or whether it was going to go down to this 1660 level. So that's the way that a market would normally play out. Now, what has happened, of course, on Friday night is that the US market has just powered straight back through that 1770 level with a huge amount of momentum. So now it begs the question, is this just a one-day aberration and we've had a little bit more of a bounce on the B leg than normal and we're still heading down? Or is the correction over? It's come down, hasn't quite got to the 1725 level. It did get to the 150-day moving average, and you can see that that moving average has pretty much contained any little declines for quite some time, and that we're now off to the races again and heading up towards new highs. I don't know the answer to that question. All I can say is that this price action is unusual, to say the least. So I'm 50-50 at this stage as to the very immediate term of the market. We'll just have to wait and see. Now, turning to the Australian market, our index fell 24 points on the week. That will certainly be turned around on Monday, as often happens. Now, our market dipped below the 150-day moving average, got down close to the 200-day moving average, which means that it's not as strong as America. It also reached oversold, and I've explained why these levels do tend to provide support. So let's have a look at the Australian market quickly. So this is the XJO, or the ASX 200. Now there's a couple of lines here to look at. The red line is the 150-day moving average, and we've certainly dipped under that. But you'll notice that there's also a pretty clear trend line, which started back here in June of 2012. So it's been running now for more than 18 months, close to 20 months. And picked up these lows through here in the middle of last year. And you'll notice that the price got down fairly close to there as well in the last couple of days before bouncing on Thursday and Friday. So the Australian market, as has been the case for most of the last 4 or 5 years, is underperforming the American market, but will just tend to follow along with the American market. Now, there's definitely been a rotation out of banks into resources. This is the resource index, the materials index, which is really reflecting BHP and Rio. So you can see that we had a really good rise coming out of June last year, and then it's been pretty much a trading range since then. But let's have a look at the banks. You can see the banks definitely forming lower highs and lower lows. So the banks definitely underperforming resources over the last few months. Now, turning to gold. Gold lost $26 the week before last, regained almost all of that on the week just gone. Gold stock indices, so that's basically measuring the major gold stocks, slightly outperforming gold, but nothing dramatic at this stage. However, I'm trading in America and trading some gold stocks in America, and there are some individual outperformers that have done very, very nicely. So the indices are kind of masking a little bit of what's happening over there. And silver's still not following as yet, most unusual. So let's take a look at gold and silver. First of all, we'll look at gold. So you can see we've got the red 150-day moving average line You can see now it's definitely flattened out. Whether gold is actually ready to move or not yet, it's stopped falling. I think it's pretty safe to say that moving average is flattened out. We just need to see gold above this peak here from the 10th of December, which is at 1370. As you can see, it's had a couple of looks. It's had about 3 attempts to break above that level. None of them have succeeded as yet. So looking for a move above that level and then a move above the moving average. And then ultimate confirmation, of course, is then a close above this 1440 level, as I've been pointing out now for probably 6 months. This is silver. It's in a really tight range now. I'd expect that silver will break out to the upside fairly soon, but hasn't moved yet, which is a little unusual. Let's look at the gold indices. This is the GDX, which is the major gold miners, and the purple line is the 150-day moving average. The red line is the 50. They haven't crossed yet, but they're getting closer. Certainly getting closer, and both averages now have flattened out, and it won't take very much for this 50-day moving average to move up and break through. Just looking at the juniors, they've done a little bit better, as you would expect, because there's a little bit more leverage there. So definitely gold stocks on the improve. Now, copper bounced back to $3.26. It got a bit dicey last week or the week before last, but did bounce back. And oil also jumped up to $100 during the week. This is the spot copper chart. There's showing you the rebound there. So just looking from an overall strategic approach, resource stocks and gold stocks I think will be the outperformers this year. It's certainly going to be a year to buy the dips because I am fundamentally bullish on stocks. Is the correction finished? Yeah, I don't know. 50-50, toss of the coin at the moment. We really need to see another few days of action in America to answer that question. So the only way to play this market, I believe, is I don't believe it's appropriate to sit completely on the sidelines, nor do I believe it's appropriate to be really ramping up your exposure. So a bit of cautious buying into the right sort of stocks could pay dividends. And if anyone wants to talk to me about trading and how you can go about a very consistent business approach to the market, treat your trading like a business, not like a hobby, then by all means get in touch with me. There's my email details there. And look forward to talking to you next weekend. Cheers.